When it comes to different types of investments, stocks are superior. There are a variety of asset types available in the financial world: stocks, options, bonds, mutual funds, and commodities. It becomes difficult for common investors to select the asset type for investing their hard-earned money. It takes a lifetime to understand the investment landscape thoroughly. Not everyone could commit to doing it professionally, so we must pay heed to what the professional investors say. One of the most successful investors of all times, Warren Buffett, has outlined 3 investment classes. First, currency-based investments. The most common example of such investments is bonds, which are tied to a national currency. In essence, bonds are loans. The bond issuer, usually a corporation or government, sells a bond to an investor. The bond issuer also agrees to buy the bond back in the future for the same amount plus interest. Since bonds are tied to a currency, they have a drawback. With inflation, the value of the currency reduces. Thus, inflation eats the interest you receive on the money. So in the end, you'll not get any real benefit from this investment. Second, unproductive assets. The assets which don't generate any additional income once you own them. Examples include gold, oil, rice, and other commodities. You buy them and hope to sell them at a higher price in the future. These are unattractive assets as they don't create additional income for you as long as you have them. Third, productive assets. This is Buffett's favorite asset class. This is the best way to grow your money and generate a long-term income. This includes shares of a company or a real estate that you can rent. When you buy shares of a company, you also become a shareholder of that company, and you are entitled to a share of its profits in the form of dividends. This asset class is the best investment strategy as it also generates a secondary income in the form of rent or dividends. How companies work and generate cash. Effective investment in shares requires an understanding of how companies generate and use cash. A company is like a black box with input and output pipes attached to it. As an investor, you are unaware of things happening inside the box, but you can understand what happens outside the box. The goal of any company is to create value for its investors. The input pipes represent the sources from where the company gets the money. Some of those sources could be the revenue earned by the company from the sale of its products or services. Borrowed money means the loans taken by the company. A company also earns money by selling its shares to the investors. The output pipes represent the avenues where the money flows out from the company. It includes the ongoing expenses of the company, like employee salaries, operating expenses, capital expenditures when the company decides to expand its operations, acquisitions when a company buys another company. Profits, the most important output pipe to examine. This pipe shows how the company is using its profits. This could be used in the form of dividends, sharing the profit with the shareholders. It is important for a company to generate returns for its shareholders. Share buybacks. This involves buying a company's own share from the open market. This is a common business practice to reduce the total number of shares in the market, which increases the value of each remaining share. This also increases the amount of dividend the company earns from its own shares. Retained earnings. This is cash retained by the company to invest in its growth and expansion. The Falcon method recommends a buy and hold portfolio for the best chances of success. Only a handful of people live a luxurious lifestyle by making money from the stock market. Majority of the investors follow the classic quantum investing method. In the quantum investing method, an investor ranks a set of stocks on the basis of some quantitative criteria like EPS, earnings per share, or dividend per share. After curating a list of the best stocks based on these criteria, the investor buys the stocks and holds them for a period of around 12 months and then sells them back for a profit. This process is repeated every year. The quantum method is a good way to remove the psychological bias by relying on the quantitative criteria. This method helps in preventing losses by focusing on numbers and data rather than on human emotions. But this method has a few drawbacks. First, the quantitative criteria might result in a set of companies which you are not familiar with, and thus investing in uncharted waters could be dangerous. Second, this method is highly inconsistent. Since the investor is following an annual cycle of buying and selling, they might end up in losses as some of the companies might not generate any profits for a couple of years. and many investors don't have the patience to hold on to their investments. To overcome these problems, you should follow the Falcon method. The Falcon method also focuses on psychological and emotional decision-making. It suggests buying and holding the stocks for a longer term. The goal is to receive continuous dividends and get the benefits of growing value of the company's stocks. The Falcon method suggests investing in well-known and reputed companies only. It is a better idea to invest to trustworthy companies rather than investing in those companies which you haven't heard about. Additional filtering of companies provided by the Falcon method generally results in good investment decisions. The Falcon method suggests 5 steps. Select a group of top-quality companies. Identify stocks that can be bought cheaply. Create reliable filters to refine your shortlisted stocks. Rank the survivors. Incorporate your own judgment. Select a group of top-quality companies. Now that you want to build a buy and hold portfolio, the question comes which companies to select. We cannot look at the metrics like revenue or cash flow, as these can be easily manipulated by the companies. An example of this is a company called Un2known, an electricity and natural gas supplier. In 2000, Un2known reported revenues of over $100 billion. Later in 2001, fraudulent activities at Un2known were exposed and the company filed for bankruptcy. Instead, we should focus on the companies which have been paying dividends for the past 20 years consistently. Dividend payouts are the transparent transaction between the company and the shareholders and cannot be falsified. Shortlist the companies which have been the dividend payout ratio of at least 40%. Dividend payout ratio is the amount of profit the company is sharing with its shareholders in the form of dividends. Why should you be looking at dividends for the past 20 years? Why shouldn't we consider a relatively shorter duration of 5 or 10 years? This makes sense because of 2 reasons. First, we get to know how the company performs in tougher times like the financial crisis in 2008. Second, the ability of a company to reliably pay a consistent dividend makes it an attractive investment. But sometimes it makes more sense to invest in the company's growth rather than paying increasing dividends. The Falcon method is flexible to accommodate this. It suggests focusing on long-term dividend payout with no reductions. Identify stocks that can be bought cheaply. We know that the secret to making money from the stock market is to buy low and sell high. But this isn't as easy as saying. After shortlisting the stocks, we should regularly track them and buy them when its price falls below its historically accepted average. Businesses create value for their investors, and we put a price tag on them. Every company has a price assigned to it. This price is different from the intrinsic value of the company. The intrinsic value of the company includes the company's assets. The share price of the company is based on the intrinsic value and its future potential. We humans are very emotionally and psychologically biased. Our decisions and actions are influenced by the emotions of fear and greed. When fear takes the front seat, we tend to sell the stocks, which leads to the decline in the stock price. However, the intrinsic value of the company generally stays the same. This is the perfect opportunity to accumulate top-quality companies. The reverse is also possible. When everything is stable, the stock prices tend to move upwards. At such times, it is important to resist the temptation to buy the stocks when they are trending at an overinflated price. Be fearful when others are greedy and greedy when others are fearful. Create reliable filters to refine your shortlisted stocks. After shortlisting the stocks which can be bought cheaply, we need to add additional filtering to refine our list. The Falcon method suggests the following 3 indicators: dividend yield, free cash flow yield, shareholder yield. Dividend yield. Dividend yield is the dividend paid compared to the stock price of the stock. Dividend yield = dividend stock price. If a stock is trading at $10 and the company decides to pay $1 per share as the dividend to its shareholders, then the dividend yield is 10%. Free cash flow yield. Free cash is the money left with the company after it has paid all its expenses. When cash flow is positive, it indicates that the company is generating more cash than is required to run the business. Free cash flow yield = free cash flow per share stock price. If a company has $100 as free cash and there are total 100 shares of the company, free cash flow per share = 100 divided 100 = 1. If the company's stock is trading at $10, Free cash flow yield =, 10%. Shareholders yield. Shareholder yield denotes the amount of money the company is sharing with its shareholders in the form of dividend or share buybacks. Share buyback is the process when the company buys its own stock from the open market. This helps in increasing the company's ownership stake and results in an increased value of the stock. This also helps in increasing the dividend payout. Define a minimum value for all these indicators before filtering your list. Rank the survivors. After filtering your list on the precious criteria, you are left with a set of profitable investment options. Now it's time to rank the survivors. Falcon method suggests ranking the stocks on multiple factors rather than ranking on any one metric. It suggests assigning some weights to those factors to calculate the rank. For simplicity, let's assume we assign 33% weight to all three factors from the previous step. Dividend yield 33%. Free cash flow yield 33%. Shareholders yield 33%. To calculate the stock's final scores, multiply each of the three yield percentages with this weight and then add them together. This will give you a way to rank your shortlisted stocks. But the Falcon method suggests using another metric, as these metrics have already been used in the previous step. The Falcon method suggests using a modified Chowder rule. The Chowder rule works by adding the dividend yield of the stock to the percentage a stock's dividend has grown by in the last 5 years. The Falcon method suggests using varying time frames of 1, 3, and 5 years for the Chowder rule. You can then assign weight to these new factors and use them for ranking. Incorporate your own judgment. The first 4 steps of the Falcon method suggest using quantitative indicators to shortlist a handful of good companies from the ocean of available options. The quantitative indicators help by removing any psychological and emotional bias from the filtering process. Once we have a first-grade investment opportunities list, we can add some subjective judgment. First, we need to pay attention to ROIC, return on invested capital. When you invest in a company, you acquire a stake in the company. As an investor, you want to get good returns on that investment. ROIC denotes how well the firm is able to utilize the resources at its disposal. The Falcon method suggests the buy and hold strategy for good and consistent returns. So you must try to avoid investing in cyclical stocks. Cyclical stocks are those whose price fluctuates wildly within a range. These stocks are volatile in nature and generally don't generate steady returns. Like any other investment strategy, the Falcon method also has some drawbacks. By following the Falcon method steps and using its recommended financial indicators, average traders can give themselves the best possible chance for growing their wealth and building a passive income.